Hi everybody, this is Jim Duffy with Mortgage Lender Atlanta. That's my blog. If you haven't been to it, I hope you pay a visit and I hope you enjoy it. I'm going to talk about the different types of loans today. A lot of times people are confused as to what type of loan to get, and more so now than ever, people are saying, wow, those ARMs, those adjustable rate mortgages, stay away from them. I'm going to try and dissuade some of the misrepresentations there and get down to the facts. First type of loan I want to mention is a fixed rate loan. Basically there's two types of fixed rates, the 30-year fixed rate and a 15-year fixed rate. 30 years is right around 5% right now. Since last December of 2008 it's been floating between 4.5% and 5.5%. Right now we're about 5. The 15-year fixed is almost always a half point below the 30-year fixed. Even though you have a rate savings on the 15-year, you know your payment is going to be higher because you're paying it off in half the time. So always consider that you're going to save on interest, but you're going to go up in payment on a 15-year fixed. Then you have a hybrid adjustable. Those are your famous 3-1, 5-1 ARMs, 7-1 ARM, 10-1 ARM, as well as hybrid adjustable. These are sometimes called intermediate fixed rates. You have a variation on the theme, which is a 5-6. The 3-1 ARMs and 5-1 ARMs, basically the first number is how many years it's fixed for. 3 years, 5 years, 7 years, 10 years. The second number is after, say, a 5-1 ARM, after the first 5 years of fixed rate, this becomes a 1-year adjustable, an ARM, ARM, adjustable rate mortgage. It adjusts every year. Some adjustables adjust every 6 months. Some, for example, in the case of a 5-6, it becomes a 6-month adjustable, and some every month. Adjustable rate mortgages are not difficult to understand. Essentially, you have an index plus a margin. The index changes all day, every day. Can be tied to various different things. The London Interbank Offered Rate, the MTA, which is a rolling average of the Treasury Index, the COFI, or 11th District Cost of Funds Index. Whatever index you're tied to, by definition, they are adjustable. They are changing and daily. Your margin is the fixed portion of your adjustable rate mortgage. Typical margin on a conventional adjustable rate mortgage is about 2.25. Sometimes it's as high as 2.75, 2.75. On a FHA adjustable, it's 2.0 normally. But it's going to be in that range if you have a good loan that you can probably live with. You add your index, let's say London Interbank Offered Rate, to your margin, 2.25 fixed, and that gives you your new rate. Currently the LIBOR is just over 2%. You were to add your margin and adjust out today, you're going to be at 4.25% interest rate. Not bad. I can live with that. But 18 months or so ago, the LIBOR was at 5.4%. Add that to your margin, which is still fixed, 2.25. You're going to be about 7.75% interest. And you say, man, that doesn't work for me anymore. I really wish I'd got that fixed rate mortgage when it was back at 5. Here's the thing. There is no mystery to an adjustable rate mortgage. It's index plus margin equals rate. The mystery is, when do you get an adjustable rate mortgage? When do you even consider it, and when do you not? If you're in an adjustable rate right now, you're happy. You probably want to go to a fixed rate fairly soon. And if you're looking to buy a home right now, what do I recommend? Pretty much a fixed rate for the vast majority of borrowers out there. A few are okay with ARMs. Hybrid adjustables rather. Fixed rates for the rest, because rates are so low it just makes sense. Now, here's why I say that. The Fed has limited means at its disposal to fight inflation. And with all the bailouts and everything else, I personally think inflation is right around the corner. When that takes place, if that takes place, the Fed is going to be raising short-term interest rates, specifically the Fed funds rate. Prime rate is tied to that. LIBOR is not tied to it directly, neither is the MTA or the COFI, but they do all track along the same lines. There we go. And as the Fed raises rates, the LIBOR will go up as well. It traditionally has always tracked the same rate. So I think these rates are going up, and I think once you add your margin, your rate, if you're an adjustable, is going to go up right now. Just not the time to get into an adjustable rate mortgage, in my opinion. For the vast majority of people, once again. So there you have it. fixed rate, hybrid adjustable, and ARMs. That's what we have going on. I wouldn't recommend an ARM right now. However, in the right interest rate environment and the right time in your life and the right plan, a hybrid adjustable or even an ARM can make huge sense and save you a lot of money. We just happen to be not in that time right now. So thank you. Once again, I am Jim Duffy, and here we go. My blog is mortgagelenderatlanta.com. Hope you make it there, and I hope you enjoy it. Talk to you soon.